All right, guys, today we're turning left out of Sydney and we're heading south down to Berry. Now, interesting thing about this market is relating to affordability, because a lot of people look at affordability and try and measure it with interest rates, house prices relative to incomes for a local area. We see a lot of migration coming out of Sydney into that Berry market, but the highest brackets of age demographic occupying that market are 59, 66 and into their 70s. So typically there might be some households that still have some debt held on those properties, but primarily what we're seeing is debt-free properties within this market. So affordability isn't completely relative for this market. It is getting up there. It's 1.77 million. So for local incomes and families looking to influence that market, they won't have a major influence because it is becoming unaffordable for even two-person households. But for the primary demographic who are occupying that market, affordability is relative because they might be coming from, migrating from Sydney and they've sold a house for $4 million. So when we take into consideration debt-free properties, affordability is only one factor we need to consider, and we need to have a look at everything else. So straight away, close to 1.8 million, typical price, not the median, and it's up 2.7% this year. There's a slight imbalance between dwellings to population, but not on the typical 2.4 or 2.5 on average people per household. Strong economic diversity, a lot of infrastructure as a non-residential per capita spend, but that's not too surprising, and I don't think too much influence on infrastructure for that particular market. It's more of a lifestyle purchase. Over the past 10 years, it's done 80% growth, which isn't spectacular, but it's not bad as well. Obviously, at least your property's still growing up, but I think it's only trading at around that 80% because the last 3 years has been negative and plateaued growth. So if we registered that 10-year figure from this high, it probably would have been north of 100% over 10 years. But you can see here there is that short-term deviation, and I think we're going to have an uptrend very similar to what we saw here. You can see that it's already started to happen. The 1-year growth is higher than the 3-year growth, so we can start to see the price movement start to take effect already. Rents are only up 34% over the past 10 years, which isn't surprising. At a typical price of 1.7 million, there wouldn't be much investor money flooding into that market. And you can see the growth cycles. The highs do get higher, but there's also, it is a pretty volatile market. There's not a lot of consistency. Other than that, you've got constant peaks and troughs. The good thing is that it's not going below negative growth, obviously, just after this massive spike in COVID-19, but this is really consistent across a lot of markets across Australia. So you can see that pattern deviation over 3, 5, and 10 years, but there's also potential for spillover potential from more expensive neighbouring markets. So relative to price growth deviation and spillover, this looks like a really favourable. Economic profiles down in Berry, not surprising. Great rent-to-owner demand in that market and very little units. There's obviously a lot of people who are wanting to occupy 3 and 4 bedroom family homes. Like I said, affordability, it's not completely relative for that market, but there's obviously still families that do provide a level of influence to this market, but it is trading below that affordability index. So the fact that it's trading below that index, you've still got families that do influence that market, but then you've got other money migrating south from Sydney, and a lot of households that don't have debt held. I think this is looking like a favourable market. Again, I don't think it's going to be outstanding growth, that it's going to be anywhere excessive over that 100% growth, but at least I would be comfortable in saying that if you're purchasing in this market, you're going to achieve double price growth over the next 10-year period. In terms of supply and demand, the supply looks good. The fact that it's only got less than 1 month worth of supply, but just one of the major things for a lot of people buying and selling is liquidity risk, especially if you're an investor and you need to minimize that risk of potentially not being able to sell your property. But it's also important for owner-occupiers in this market as well, that if you look to go and sell your property and you want to buy in another market or whatever it is, take into consideration that at the moment it's typically trading at 120 days. It's taking 120 days to sell a property. Obviously, there's exemptions to that, whether it's more affordable, more expensive, or it's a 3-bedroom and there's a lot of interest for the 4-bedroom market. It's all relative to the individual property itself. So I think if you are looking to buy in this market, or if you're looking to sell in this market, I would be looking at what your particular product is and trying to filter for that on Real Estate and Domain to see how long those particular properties are taking to sell based on bedroom and bathroom makeup based on what the typical price is, what the land size is, where it's located, and it will all be dictated by the asset itself and how long it's actually taking to trade. There'd be a lot of properties in this market that are north of that $2 million price point, which is probably bringing up the average days on market. Vacancy rates, even though it's not a massive investor market, vacancy rates are still quite low. Again, this is just a high level figure. If you've got a very desirable asset that's affordable in this market, that's going to lease a lot faster, that's something more expensive and something that the typical rental profile can't pay for. In terms of everything else, search index is probably pretty relevant for this market. There's a pretty balanced search for buyers and renters within this market, but it has slowly started to taper off in the last quarter of 2025. So it'd be interesting to see what the first quarter of 2006 shows for that. Very, I think it's favorable if you are looking to purchase there. If you're looking to invest, there's plenty of other better markets in my opinion. But if you are looking to buy and bury to live, I think it's still a very safe market for you to buy in. But just take into consideration that liquidity risk for when you do go to sell. That's it, guys. If you like these videos, hit subscribe, and I'll see you on the next episode.